If Bitcoin were backing, say, 20% of new T-bill issuance, which maybe in a generation, that could be the case, then it will be reasonable to think about the moral hazard associated with if Bitcoin went down 99%, right? But I think that for the world as it is now and likely to be for the next few years, it's more likely that the government takes its piece by financial repression, higher taxes on Bitcoin mining, royalties or transaction taxes on self-custody transactions, things like that.
Easier things for them to do.
Easier things for them to do.
Matthew Sigel, head of digital assets research at VanEck, says the idea of the U.S. government buying Bitcoin outright is largely unrealistic. Even if policymakers wanted to, he argues, it would be nearly impossible to accumulate a meaningful amount without congressional approval. Anything tied to federal finances, whether it adds to or subtracts from the budget, requires legislation. That makes the odds of a massive federal Bitcoin purchase slim. This view aligns with comments from Treasury Secretary Scott Bessent, who told Fox Business on Thursday that the government will not be adding Bitcoin to President Trump's strategic reserve. Still, Bessent confirmed that assets already seized will continue to be held and that future confiscations could expand the reserve gradually over time. Sigel notes that some imagine a future where as much as 20% of new Treasury issuance is backed by Bitcoin. While that might sound ambitious, it also carries enormous risk. If Bitcoin were to collapse by 99%, the economic fallout would be devastating. For the near term, Sigel believes Washington is more likely to target easier wins such as higher taxes on mining, fees on self-custody transfers, or skimming a share of stablecoin activity rather than stockpiling BTC. On the subject of stablecoins, Sigel observes that the federal government doesn't appear eager to launch its own. Instead, innovation is happening at the state level. Wyoming, for example, has been experimenting with state-backed digital tokens. The bigger challenge, however, is interoperability. If a Wyoming-issued digital dollar exists, will a merchant in Miami or New York accept? At least initially, the answer is probably no. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
My expectations have been pretty low on federal government acquiring Bitcoin. I actually think Bessent said the truth, kind of maybe by mistake, with his comments yesterday about how there won't be a seller. I think it's going to be very hard to acquire Bitcoin in a material size in a budget neutral way without legislation. Just because something is budget neutral doesn't mean it doesn't require legislation, right? Anything material to the finances, even revenue neutral, requires legislation. If Bitcoin were backing, say, 20% of new T-bill issuance, which maybe in a generation, that could be the case, then it will be reasonable to think about the moral hazard associated with if Bitcoin went down 99%, right? But I think that for the world as it is now and likely to be for the next few years, it's more likely that the government takes its piece by financial repression, higher taxes on Bitcoin mining, royalties or transaction taxes on self-custody transactions, things like that.
Easier things for them to do.
Easier things for them to do. I think, or we think, is in the clearing of stablecoin transactions. So the federal government's not going to do one, right? There's even kind of proposed laws out there to make it impossible for CBDC, but individual states likely will. I think Wyoming has been on the front foot about that. And then it's questions is merchant acceptance. Who's going to accept these things? If you go to Miami with your Wyoming stablecoin, is it going to work, right? So
you think the states are going to do it for real?
Yeah, it's not very easy. They're going to be at scale, right? Government rarely does anything super well. So then I don't think everyone's going to be suddenly in Wyoming using Wyoming dollar and things like that. But they're going to experiment, and experiments will have varying successes. But who's going to be the interoperability layer for all those stable coins? Because according to federal regulation, they're all going to have pretty similar structure. In the public equity space, some of the kind of merchant acquiring businesses or fintechs that help retailers accept whatever payments they want. So they're a lot of those guys are starting to add crypto, right? Shopify is kind of a hybrid example of that. And then what coins do they accept and what do they use for the interoperability? They actually will have some market power because there's going to be a lot. If this does trickle down to retail / small business, where our base case is it's mostly multinational remittances is probably the biggest use case of stablecoins over the next year or two. But if it does trickle down to this everyday experience, it'll be interesting to see how the merchant acquirers deal with it.
4-year cycle over, or do you think that it will remain?
I lean towards remain, but in a more muted fashion. So that's kind of a wishy-washy answer.
Yeah.
But it's been around for so long, I'm going to give it the benefit of the doubt. Next year we have kind of midterms heating up. It's going to be not much happening in terms of progress in Washington. The rate cuts might be kind of well known and already enacted by then. Like, it's too early to say, but I'm definitely on the lookout for a down year at some point here and cycles resuming. But definitely with the ETFs and now the corporate buying, hopefully there's some more counterbalance to that.
Matthew Sigel advises investors to keep a level head when Bitcoin is trading at or near all-time highs. The temptation is to chase the next big winner, but Sigel stresses that the more brilliant move is diversification. When markets are this strong, almost every asset tied to crypto is rising. You might miss the next 10x moonshot at this stage, but by spreading risk, you also avoid the kind of blowups that can wipe out portfolios during downturns. Sigel's approach is built around discipline. He points out that drawdowns are inevitable, and it's in those moments that investors can shift gears, dialing back defensive positions and leaning more into volatility when the odds favor more substantial gains. This mindset keeps capital intact during overheated rallies while leaving room to benefit from future dislocations. What encourages Sigel most right now is the performance of the ETF his team manages. It has not only delivered outperformance versus Bitcoin itself, but also done so with less volatility. For investors, that combination, higher returns with a smoother ride, is the sweet spot. It shows that thoughtful allocation can beat raw exposure, even in a market dominated by hype and speculation. Let's get back to the interview.
We've been running crypto equity strategies for almost 5 years now, and what we noticed is that they are really, really volatile. And the tendency is that at the top of the market, the ones with the most leverage are going up the most and doing the best. Leverage is toxic to Bitcoin, as we learned over the last few cycles. And what that dynamic does is that basically at the top of the market, your crypto equity indices are full of the most leveraged stuff. So when there's a washout, like, they're overweight that high leverage, and the drawdowns have been considerable, and the since inception performance of a lot of the crypto equity products have been subpar from my perspective as someone who wants to put a meaningful amount of my own money in products that are Bitcoin aligned. So what we aim to do with On-Chain Economy ETF, and, thanks for calling out the performance. I just want to be clear that, I think those numbers are correct through, August 14th or something yesterday. And, but the past is no guarantee of the future, and we're trying our best to manage this portfolio according to this guidelines, but we might be wrong. We might be lied to. You never know. So investing is risky. So not financial advice, but, what we're trying to do is take a very wide approach to the space. Any company that has articulated a strategy to make money from the on-chain economy, whether that's as a dealer of digital assets like Coinbase or Bullish, who just came to market, but also whether they're a provider of infrastructure into the space. And given Bitcoin dominance still here up around 65%, some of the biggest infrastructure providers are selling electricity, electrical equipment, other kind of industrial infrastructure. And it's becoming meaningful to the EPS growth. We think it's becoming meaningful to the multiple. They're increasingly calling out the tailwind from Bitcoin mining. I'm referring to that kind of energy and utilities slug. But then you also have this whole class of kind of what I'd call fintech e-commerce names that overlap with some of the Mag 7 in the US, but they're focused on LATAM, or they're focused in Asia. And some of those companies are starting to adopt stablecoins, significantly and calling it out as cost savings. So anyway, the big picture here is that our investment universe is vast. It's over 150 names that are have articulated a strategy in digital assets. And we're targeting this barbell approach where, yes, we have some of the pure plays. It's roughly a third of the fund is in kind of that pure play crypto equity space. We have the peripherals bucket where we're into that e-commerce, fintech. And then we have the low volatility bucket, which is this kind of utilities, energy, infrastructure component. And that provides a lot of ballast. I'm trying to compound, avoid big drawdowns by being very diversified. I feel like when Bitcoin's, up here near all-time high, being diversified is a good thing. Kind of the rising tide lift all boats. You might not catch the next 10 bagger, but maybe that was really the trade a year ago, to look for 10 baggers. And then as we have drawdowns, we'll be able to kind of jettison some of that low vol ballast and turn up the dial on the volatility. So I think what I'm most pleased by is that the outperformance versus Bitcoin since inception has come with lower volatility. So twice the performance at lower volatility. For me, that's a sweet spot. There's no guarantee we can duplicate that, but that's what we're aiming to do.
What stands out from Siegel's perspective is how much of this debate isn't about technology, but about politics, regulation, and risk management. Washington may flirt with bold ideas like Bitcoin-backed treasuries, but the reality is more measured: incremental taxation, fees, and oversight rather than massive government stockpiles. For investors, that means the real edge comes from strategy, not speculation. Balancing exposure, guarding against shocks, and knowing when to lean into volatility could prove far more rewarding than betting on sweeping government moves that may never arrive. Do you think investors are better off preparing for gradual regulatory shifts around Bitcoin and stablecoins rather than waiting for dramatic federal adoption? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.